Okay, great having you here.
Thank you.
So maybe since many entrepreneurs, you can introduce yourself, especially what kind of investment you are making.
Okay, I started Bullpen Capital. Before that, I was a 4-time founder, and I also worked at a really big venture fund, a really big one. Had 2 IPOs, one in both in the 90s. It was kind of fun because one of them had $1 million of revenue and got to like $8 billion market cap. So there was a week we were the #1 most overvalued company in the history of the NASDAQ. And then I'm proud of that, by the way. So Bullpen Capital, when we started it, we were all operating people, started companies. And we looked around, and most people start venture funds and do what everybody else does. We looked around, we looked at Paul Graham-White Combinator, the first really good accelerator, amazing innovation. We looked at Josh Koppelman, who helped start our fund. First round capital, one of the first modern seed funds, terrific innovation. So we said we want to be innovators, not just do what everybody else does. So Bullpen is a post-seed fund. The concept is you get your seed, and you don't go from $1 million of seed to a 10, 12 million A round. It's too big a leap. You first do a post-seed round of 3 or 4 million, which sets up the next big round. Now the stats are showing our thinking pretty solid. When we started doing this, the seed to A graduation rate in 2010, about 45% of the companies graduated from seed to A. Today, it's fewer than 10% graduate seed to A. So it's gotten very, very tough out there. When we started Bullpen, we saw this was going to happen in the sense that there were around 20 really good seed funds. We thought there would be 100 in 5 years. It turned out there's 300. So a huge influx of seed funds, happy angels, really big growth of seed deals. But the Series A guys shrunk from about 1,000 at the end of the bubble in the year 2000 to fewer than 100 today. It's an amazing shrinkage. They all got really big. So a really big fund has to write a $10 million check. They can't play with small checks. So we figured out that was a niche to be in. It's done extremely well. Our post-seed to A graduation rate is well over 50%. So I think we proved the thesis.
Okay, great. So you co-founded a couple of startups, including Sc.B, Xumii, and several other startups. What drove you to Bullpen Capital to become a VC?
Well, part of it is this is really a game for innovation starts with young. So it's really a game that should be played when you're young. So I said age out of the startup the sad. But the other part of it is when I was at the big venture fund, one of our deals was MySpace. So do we all remember MySpace?
Yeah.
Even as late as like 2009, it was neck and neck with Facebook. Amazing. And since we did that deal, we got inundated in 2006 or so with these Web 2.0 social startups. Now, it was a big fund, we got $1 billion. Can't do that right. Students, $1 billion. So it was a big fund. And we couldn't write a small check. We wrote 10, 12, $15 million checks. So in come these deals, and they only need 500,000. So I had this visible proof that something had fundamentally changed the ecosystem. The 2 companies I did in the 90s, one first round of venture funding was 10 million. The other, it was 20 million. It took a lot of money to start a company then. So something fundamentally changed. When I found out that my big fund could not do the small deals, I began thinking, how do we do this? And the journey got me not just doing the startup, this company Xumii, but also into a little accelerator incubator. And it's through that process we figured out the really interesting place to be was post-seed.
Got it. So how many personal exits you have in total? And how do you make the decisions about selling the company?
I don't know the exact number. We did an angel portfolio.
How about yourself?
Me personally?
Yes.
Me including my own companies and everything?
Your own company.
So I was in 4 startups, 2 IPO, 2 were bought.
Wow,
that's not bad. Yeah, the IPOs were fun. We should all, okay, who misses who would love to be in a bubble, first of all? Bubble, good. You should all raise your hand. Adam knows this. It was a lot of fun. It was crazy. Since then, I've had only 3 exits. There were some investments we did in our angel portfolio and then in our fund 1. And however, we do have, so our angel portfolio of 20 deals. It has 4 IPOs and a 5th unicorn still private. Our fund 1 is 2 unicorns, which isn't bad. And we think there's a 3rd that might get there. So our exits turned out to be quick flips in the 50, 80, $100 million range. So we're actually holding on to these properties so we can get a big outcome from them.
Okay, so you announced an $85 million fund, new fund for us. Congratulations. So what's new and what's changed? So now you have a little more money.
When we started doing this, the amount of seed money for us accumulated about 750, 800K. And then that was during Fund 1. During Fund 2, it started getting up to $1 million, maybe $1.2 million. In the last year and a half, it's gone way up. So we're now seeing seed deals come to us with $2 or $2.5 million. We're still finding that post-seed thesis holds, because basically we invest about a year and a half after the company starts when there's some product market fit. And they're still usually not ready for a $10, $12 million check. So what happened to us is the average amount of money we put in a company and the size of the post-seed round also grew. Now we're putting in $1.5 million, $2 million checks and a $3 to $4 million round.
So in the investment made in the last few years, what are the investments you are on?
Well, my favorite is wag walking. And I don't know if you know wag. Who's got dogs in here? Anybody's got a dog? You use wag walking?
No, because it wasn't made.
Okay, so WAG is, so 3 years ago when there was this crazy Uber for X craze, Uber for everything, people get on stage and say, this is so crazy, it'll even be Uber for dog walking. So we funded that company, and it is absolutely crushing it. This company is just raising a big C round, it's crushing it. So that's my favorite company right now. Because it turns out dog walking is a gateway drug to all things dog. Dog grooming, dog sitting, dog food, etc. For those who didn't see the news today, Xumii, dog food company, just got bought for $3.3 billion. How cool is that? It's the biggest e-commerce exit ever, and it's in the dog business.
Unbelievable. How's the investment doing financially?
Wow.
Yeah.
Doing fabulous. I mean, it's just, from the point of view of venture person, you look at how you put in money early and how much it increases in value. This thing has been increasing quite nicely. So I can tell you more, but we're very happy with it. We have some others. There's a deal called Spot Hero. I don't know if anybody, do you guys remember Zerks and Lux? They were on-demand parking companies here.
I use those.
Okay, so Spot Hero is a blue-collar version of that. So they cut deals with all the garage openers, so garage owners. So they have all these downtown garages and they get slots. So what they figured out was an empty space or slot in downtown garage is like an airplane seat without the United people. So basically, if the garage does not rent out that space, they lose money. It's a fixed cost, marginal. So they pick up all the marginal spaces, just like hotels or airplanes sell it, and that's what they're selling. That thing is doing amazingly well right now, but it's a very blue-collar thing. It's an on-demand app. You go to Spot Hero, you can find your parking place. But it's a guy who cut a deal with garage owners. So think about that. So it's a very different type of deal. But we love that deal. It's been great.
So what type of investment you are still actively looking for?
Well, I think we're in a transition from social mobile into, I guess people always call it frontier tech. There's always the frontier. But in this case, frontier tech looks like robotics, 3D printing, AI, Internet of Things, that type of stuff. Drones, autonomous cars. So we're transitioning our investing focus from the stuff that's been really hot for the last 5 or 6 years into the new stuff that's coming up.
Okay. So in the investment activity, statistics that just sense, I believe it's Q4 2015, the activity had dropped a lot, especially in 2016. I hear this year, this Q1 is coming back a bit. Do you believe,
So it's a very good, I don't know if you guys all know this, you know these stats? So in August of 2015, there was a sharp stock market drop. A lot of the so-called tourist VCs, these would be normal IPO investors like Fidelity that were investing in unicorns in later stages privately. So we call them tourist VCs, but you could call them private IPO investors. They had to mark down a lot of their investments, and so they left the ecosystem. They literally left the ecosystem and left a huge gap. And you're right, all the data since then has been down. The number of seed financing since that period is actually down 40%. The number of sort of general VC is down 30%. What people don't quite know is that last year, 2016, half of all C rounds, ABC, not C, C, were flat or down. Flat or down. So there are some people like Mark Suster who says winter's over, it's coming back already. The data actually shows continuing to drop in Q1. What's going on though is quite interesting. I would call more a rotation than a drop, because the gap that was left by these tourist VCs leaving was filled by huge funds. Like Excel raised $2 billion, $500 million for their A fund, $1.5 billion for their growth fund. And that growth fund is going to fill the gap left by people.
International money.
Yes, and so we still see money flooding in. VC fundraising is actually up, not down during this period.
How about earlier stage, like pre-A to A? What's the trend is increasing?
Well, what happened is, you see it in the stats I gave you earlier, the amount of money going into a seed deal is increasing. They're getting fatter, more funded. So these 300 seed funds and angels are focusing more of their money on a smaller number of deals. It's still a very large number, not like 3 deals. It still went from like 2,000 a quarter down to maybe 1,400. So it wasn't like it went down to nothing. But they're putting more money into better deals. So that's the biggest phenomenon going on.
So where do you think the activity will go back to more warmer stage?
Well, I think what's going on. So first of all, if a lot of you are trying to raise your early money, there's a whole bunch of pre-seed funds. Now, you got to understand how funny this is. Back in the 90s, there were no real seed funds. There was A and B and C. A was the first money. So Josh Kaufman starts this industry of seed before A. Now when you look at it, nobody goes to the A funds. So Sequoia is a fabulous fund benchmark. Nobody goes to them anymore. They first go to Josh Kaufman or Floodgate or one of the seed funds. It's an amazing thing at the front end of the venture funnel, which for many, many years, since Adam's in the back here, since his great-grandfather, General Draper, was the first West Coast VC, an amazing guy. From his period in the late 50s until recently, you'd go to the Series A funds. Now you go to C funds. But here's what's even funny. Now there's 300 C funds. A lot of them have a lot of money. They're getting a couple $100 million. They look like A funds. So the new phenomenon are pre-seed funds. So now there's a whole bunch of pre-seed funds. That's who you go to for your first money. Don't even go to the seed funds. They're late stage now. Don't you love this?
So how did you find your investment targets?
We found out, we didn't know this starting off. We found out that we have an enormous referral network. So a lot of VCs hustle for deals. They hang out. They try to get people to come back to them. For whatever reason, we get referrals on almost all our deals. We don't proactively have to go out and look for deals. They refer to us. So I don't know how we got lucky this way, but our network's pretty strong.
Okay. So I heard one of the challenges many like newer VC, smaller venture capitalists facing that all the best startups because of the SendHub, top 20 send message, send big people, and everybody is nobody responds to send message to people. So how do you compete with the larger VCs?
It's very fascinating to me because our success rate in term sheet is very high. So we don't actually lose to the bigger VCs very often. In fact, our very first deal we did, there was a 6 on 22 bid. You guys know the lingo. 6 million round on 22 pre-money. Bid by one of the major A funds. And we didn't know it, but we bid 2 on 11. And we won the deal. And the deal ended up 3 on 12 as that A fund came down and was joined the round. Why? Well, the reason was the founder had twice done really good startups in the 90s where he'd raised 90 or $100 million, all in a preference stack on top of them, all the venture preferred stock above him. And he sold both companies, but he didn't make life-changing money.
I got it.
Right? They got the preference on top, and he got trunk. So this time he said, I don't want to do that. So he took the small money and kept open the option of selling quickly. He did. So he sold for, I think, $80 million, but he pocketed $20 million, and so did his co-founder. Okay, how cool is that, right? You raise some money, a year and a half later, you're worth $20 million. Who would like that? Everybody? So he took the option, kept his options open. So that optionality is huge. The other thing we find out is this. This phenomenon that C is flat or down this last year, I call it flat is the new up. Okay? Orange is the new black, flat is the new up round. What's going to happen this year, a lot of B rounds are going to be flatter down. Why? The A rounds a year and a half ago were too exuberant. They put in $15 million and you hardly had any revenue. So let's say you put in $15 million on $25 million value. For those who do math, it's a $40 million plus money. The B round people like to see a 2x increase. They want to see you worth 80 million. If you're not worth 2x, say only 1.5x, they'll wait. Because when they do the math, they'll see you again a year and a half later, and you won't be that much more expensive. So as a consequence, if you have too high a value coming through the A stage and don't get your metrics to be worth it, you'll have a hard time raising a B round. So that's part of our explanation. We actually do really well with second or third time founders because they've learned this the hard way. So we say to them, you're better off keeping the round small, your post money small. So the next round is very likely, because you hit the metrics, to get 10 on 40 or something.
So last 2 years, also was a lot of new small funds that were created in certain mega funds from $10 million to $50 million. So I've been asked many different questions about co-investment, opportunities, qualification, about different funds. So how many of those funds in the future can be truly successful? What type of fund can be successful small?
Well, it's a very good question. So I guess
what was the question?
There's now 350 micro VC funds. It's like all the business funds, and they're small funds, but so many of them. The question is, when you go through 10 years from now, how many are going to be left raising more money? So you get the question. So we have one venture guy here. So what he's basically saying is the venture fund's product is return to the limited partners. That's our product. So we have to sell return. And so you go through this huge experiment. 10 years later, you see who returned 5x and who returned less than 1x. And so it's a challenge for these people. The challenge is they have to return 3, 4, 5x on their fund, but they won't get a second or third fund. How do they do it? Well, that's an interesting question. The reason why Bullpen did something different is because we didn't want to be one of 100 seed funds. We thought it would be very competitive and hard to be different. So we actually were different. So one way they're getting around this, what's going on with the smart ones, some are doing pre-seed, as I said. So they're getting ahead of the seed guys, less competitive. Others are going vertical. We're going to do hardware deals. Nobody does hardware deals. They're doing hardware deals. Or Bitcoin or something. They go vertical. The most clever one I know has actually created a series of accelerators and sits back as the fund to fund. So those guys now got 10 accelerators, a hardware one, and this one, and that one, and they wait to see what comes out. But the point, though, is not what the answer is. These micro VCs have to differentiate themselves in some way so they can have much better returns 10 years on.
Okay, so you also mentioned earlier that you have a very strong network and many deals from referrals. Can you tell us what type of people were referring deals to?
Well, it turns out we get some, mostly ex-CEOs. Like the guy in our first deal, he was great. He referred us all kinds of cool deals. He's got a good nose and well connected. So a lot of our CEOs from earlier deals are referring deals. So it comes through that type of network.
Okay, so there's many IT startups are raising money even in this audience. If they're raising money, do you prefer them to send it to yourself, which you don't know at all, or you prefer a referral by someone?
Well, we have most VCs get way too many unsolicited business plans. And what you should know is if you just send it in, it's likely to get filed in the circular file, right here. It's like, psh. And so don't do that. That's the least likely way you'll ever get anybody's attention. The second least likely way turns out to be lawyers. So lawyers used to be good business. So you got part of the challenge. Let's put it this way: think of it as an intelligence test. You're all founders. You're all trying to do something cool. Are you smart enough to network your way? So Adam's in the back here. He's got a really cool accelerator. Let's say you want to get into it. Are you smart enough not just to knock on this door? Hey, are you smart enough to find a referral in? That's part of the intelligence test. So we want you to go through that drill because it indicates you have good networking skills. You're able to determine my deal fits these funds and not those funds. These are all intelligence tests. So come on, everybody here is pretty smart, right? Okay, you all got A's. This is what you have to do. Pass the intelligence test.
Well, so for your next investment, what are the top few things that you are looking for?
Well, we have a very interesting sort of screen. Because we're post-seed, we look for product market fit. We've gotten really good at screening people in or out. So the first thing we look for are metrics to show product market fit, not just an argument. That's number one. We're not really that focused on the type of company. We also like to find a CEO who's really, the word I use is has the chops to take it a long ways. What's interesting is about half our CEOs are first time. They're not multi-time. And they don't know as much as the people who've done it 2 or 3 times. But boy, some of them are absolutely amazing people. You wanted to ask me a question about the most impressive CEO I've met.
Yeah, so you said impressive. So I want to know what type of people. Give me some example. One of the examples you think is very impressive.
Okay, here's my favorite, and I remember her vividly. We didn't invest because between Fund 1 and Fund 2, and she got some money from somebody else faster than we could move. Tracy from a company called Tradesy. So anybody know Tradesy? You know Tradesy. So here's the thing. She comes in pitching, selling your stuff out of your closet. Now there was Threadflip and Rent the Runway and about 10 other companies doing this. So at the beginning, what makes you so special? So she sat there and she just blew us away. She knew everything about her business. She knew all her numbers. She knew all her competitors. And she had a brilliant way to position herself. And it was very simple to explain. She'd take this stuff out of the closet, film it against a white background, have an e-commerce site that looked like you were selling new stuff. And so the people knew it looked new instead of like a picture in a closet. It was a very simple but brilliant execution. But what impressed us was she knew it cold. There was no hesitation. She knew it inside out, upside down. The last time I talked to her, she's at the 100 million run rate or something. So that was about a year ago. She's doing really well. So most impressive person. So the lesson for you, if you come in and pitch, really know your business. What most people do when they pitch us is they don't talk about competition. So how can we evaluate you if you don't know why you're positioned better than your competition? It's part of the intelligence test. So just understand your business as well as anybody can understand it. And then you'll blow away any VC.
But also, earlier stage or founder scale, what other suggestions you have? Yeah.
Well, okay. Besides the referral thing, it's turned out to be a really good idea to go to an accelerator. So if you apply and get in, it's a really good thing. Even if you're in market already, these accelerators, like 500 Startups has now a post-seed track, we used to call it that. Y Combinator fits in post-seed, later stage companies without having any track. So they're a really good mechanism to get visibility and get beaten up by the mentors to fashion a really good company. So we highly recommend that, particularly if you're not from the Valley or a first-time founder. It's like you're going to startup school. Let me ask a question. How many of you went to college? Everybody? How many dropped out and joined Peter Thiel's? No? Okay, you should. It's kind of fun. How many went to grad school? How many went to law school? Oh my God. So basically, for a lot of people, their choice coming out of college, get a job, nobody wants to do that, go to grad school, or if you have to, go to law school, no offense. I went to law school too. So. Every month I get up and I'm a lawyer, I admit it, do the 12 steps. Anyway, there's now a new option, which is to start a company. And so these accelerators are startup school. And they are really good at getting newbie founders to really understand the drill. So I highly recommend it. If you don't get into one, the next best thing to do is to get real traction in the real world on no money. I mean, literally, just scrimp and save and do whatever you can to get out in the marketplace. Because for a first-time founder, your actual results speak louder than your PowerPoint. Really good. I mean, in other words, you come in and say, I don't care what you think of me, look at my numbers. Whoa, dude, right? Whoa, dudette. It's really cool. So that's my second best advice.
Okay, great. That's all my questions. I'd like to open the floor to ask a couple questions. So take the time context. I'd like to take 3 questions, and I'd like to them to be said. And all of the questions we have to answer. This will be here.
Can we go to the mic?
Yeah, you were just talking about taking a look at product market fit metrics and data measuring that. What kind of metrics are you guys looking at here?
Depends on the category. I'll give you some data. The most consistent market is SaaS. So how many of you guys are doing, gals are doing a SaaS deal? SaaS deal, okay. So it's really funny. It turns out you can know what the later stage VCs are going to do because they follow the public markets, and you can know that. So what we've been finding is, in general, public markets pay 5 times ARR for over 12 months, okay? The private markets pay roughly twice that at earlier stages because of higher growth, 10x. So let's say you want to get 10 on 40, 10 million on 40 million pre. You've got to be 4 million for over 12 months revenue, ARR, to get 40 million pre. Simple math, right? So most of the deals that go through the seed stage are get funded at 10 to 25,000 a month. Not a lot. And you multiply that by 12, it's not a big number. They come to us around $1 million ARR, 80K a month, 100K a month. And we actually make a simple determination. Do we have confidence they're going to get up to that 4 million ARR within a year, so they score 10 on 40? So to that sense, that's how we look at a deal from product market fit. There's other attributes, but that's the starting point. We also look at growth rate, we look at engagement, there's other things to look at.
What's kind of your confidence barometer? Is that based on their acquisition costs for their customers?
There's a lot of other things. So the SaaS deal, your sales efficiency better be pretty good, and your churn better be pretty low. Now, if you go away from SaaS to a marketplace or e-commerce, different metrics. You go to consumer, different metrics. You go to core industrial stuff, all this future stuff, frontier tech. Oh my God, very different metrics. I'm looking at a deal now that's selling SaaS to IBM and Liberty Mutual and Fortune 1000. You know, big, ugly companies with long sales cycle. So the metrics there are different too. So it depends on the context. But as we sit in the middle between the seed world and the traditional VCs, we have a very good feel for the marketplace dynamics. We know what the market's buying or not at what price, and it's kind of fun. By the way, most VCs are not that, I guess, numerical. You talk to most VCs, they don't make decisions that way. That's just. It's just.
You mentioned that you're moving towards frontier tech, AI, IoT, hardware. Looking at the world now, I've been in 3 startups that had exits, and it's so much easier to create a startup now, except it's so much easier to create a startup. Now there's so many startups in every possible dimension. In those areas that you mentioned, can you be more specific as to where you think some of the opportunities are?
Well, with frontier tech, especially selling industry, you don't have this type of clean SaaS numerology. So you have to rely on astrology, not astronomy. But here's an example. One of the things we ask is the market really scaling? So I can tell you, Internet of Things, industrial, is scaling very fast. You can actually see real examples in the real world being bought by industrial companies. So we know the market's growing, so when a deal comes in, we have more confidence if they're not quite scaling themselves, if they're going to a really big market. Drones, come on, drones are good. How many people have flown a drone here? Everybody? Some of you have. Haven't invested in drones. Drones are scaling like crazy. The drone itself is largely owned by DJI, one company. But the drone business is scaling like crazy. So we look at the frontier tech that is now scaling, and we stay away from the stuff that's in the future.
Last question.
What about healthcare? Just you mentioned the frontier technologies. What about healthcare? Any interest in healthcare? In Silicon Valley, they don't touch much of the healthcare side.
Well, the thing is, my prior big fund did a lot of clean tech. And so with clean tech, a lot of regulation, government money. And the government turned out to be a really bad investor. Solyndra, right? Okay, everyone's running the hills. What about all these big projects? No, politically risky. So whenever you go to an industry which is heavily regulated, healthcare, ed tech, energy in general, you're walking into a quagmire. There are people working on nuclear reactors. So fine, they're going to invent some really cool new nuclear reactors. How long will it take to get regulatory approval? The last reactor in the US is what, 3 Mile Island? So we tend to stay away from regulated industries. It's like it's a big rock in the river, and we'd rather flow around the rock than smash into it. There are things in healthcare you can look at, but the FDA is kind of an overwhelming presence. So as a consequence, most venture funds either specialize in healthcare or not. The ones that do, like pharma, medical equipment, they're very specialized. They know the rhythms of that business. Somebody who's not in the business shouldn't go there. It's too risky. You don't know what the rules of the trade are.
Okay, great. So let's give a big hand to Thank you.